Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today is our favorite day, the Primary Vision Frac Spread Count, and I'm back. I know that everyone missed me. I was giving a talk on China in Baltimore, so nothing fun. I know someone was asking about the Bahamas. I wish it was Baltimore, though it was nice to see how things have changed since I last was in the city. But today we're going to do the Frac Spread Count. We're going to look at OPEC, what are some of the flows, as we keep talking about the difference between production and exports and how has that changed. And then we're going to look a little bit at recent U.S. Data and then some Chinese data just to kind of round it out given where things sit. So without a further delay, we have the Primary Vision Frac Spread Count is up by 5. So we went from 257 to 262. We continue to get a fairly steady move up. You know, one of the things that we had said, or I should say 2 weeks ago, when I was giving this whole talk, was that we were going to see the Permian start to get to a point and then slow down. And our view was really that a 137, 135 in the Permian was about right, and we're getting very close. So that's where we're going to see some of that slowdown, but we are seeing some acceleration in the Anadarko. We expect that to continue. And we are seeing that in the Western Gulf and in the Haynesville, which I think when obviously you look at gas prices, you look at where liquids are, it makes a lot of sense. And for clients, for those that are watching, we did a big deep dive on NGLs in terms of where things are going, pricing, economics, and we'll touch on some of that here, but again, find more in the insights. So now when we look at rigs, as everyone knows, our big thing was that rigs were going to continue to ramp up, and they didn't disappoint. We had an addition of 7. Oil, just to be clear, 4 are onshore, 3 are offshore. So we're starting to get, pretty much a lot of this getting back to normal. We had New Mexico, we had Louisiana, and then we did have Oklahoma. So that's going to be one where you look at where some of the shifts are: directional, horizontal, vertical. You can see vertical is up 2, horizontal, directional up 2, and then horizontal up 3. So we're getting to that point, but again, we're going to see a little bit of this pivot, and that's going to continue when you look at when we see some of this bump in activity, which is typically when we get closer to the winter months, and you get some additional turn on within the Northeast. So we're going to start to see some completion crews pick back up because that's where they're going to be able to push some of this additional product through, especially given where some of these realizations are. So now when we start looking at the exports and where we are on production, so one of the things that we've been talking about was that real big slowdown that was in August. So this is looking at monthly change from August to September. So with West Africa, there was a big jump in September, but it was really because there was such an issue on the August months where you had downtime, you had some cargoes flipping in and out. So this was a nice little ramp up, but again, things normalize a bit more when we look at September into October. The biggest ones, that the two that we really want to look at, is Iraq and the UAE, where you look at Iraq has been seeing a very steady increase in flows. And a lot of that is actually coming into a lot of that is going into Asia as well, but we have a decent amount coming into Europe and the US, but more specifically the US. Now, the September numbers, when you look at US data, is going to look deceiving because when you look at Ida, when did Ida hit? Then you get that impact. That's when you start to go out and try to find other cargoes. They don't just show up at your doorstep. So even though September is going to be down, we're going to get a big spike in October as we take delivery of these cargoes, which should really start at, let's say, the middle of October, into the 3rd week of October. We'll start to see these accelerations that have been coming from both West Africa and Iraq. And then when you look at what's happening with the UAE, we've been talking about Russia. Russia has been gunning Urals, CPC, and on the ESPO side. So that's something that isn't surprising, but it's important to look at where our exports, because we know where production was, and we're going to continue to see additional cargoes coming to the water. And here's the West African flows. So when you look into China, the setup was a lot more Angolan cargoes actually left to go to China. There was a lot that was sitting there. Angola had a slow movement. Nigeria something similar. Then when you look to India, that cooled off a bit. You did get some cargoes, some spot cargoes going into some other Southeast Asian nations. But when you look to Europe, that's going to continue to edge higher because remember, Nigeria really slashed their OSPs to try to clear some of this additional crude, and that's going to incentivize some of these movements as we've seen from Dubai and West Africa. So then when you look at India, India's been picking up some additional Saudi flow. So now as we go into the OPEC meeting, the question is going to be, do they increase production more than 400,000 barrels a day, which I think is unlikely, but what I mean, in my opinion, would make the most sense is really cutting that OSP more than the market is expecting to show some of that. Look, we're going to help a bit by taking some of the edge off. We're going to cut some of the OSPs, give some of that margin, if you will, back to the refiner and enable additional runs. But then when you look at what's happening in India's been having an issue on the diesel side. They are now sitting there with a glut of diesel, and you're getting a bigger pivot to try to make more gasoline. And at the same time, they're cutting runs to try to adjust for what's happening. Now, given it's the monsoon season, this is the low period, but they did have a normal monsoon season, which means that the hydro is going to work as it should without needing their diesel back up. And you do have that economic problem, which continues to kind of be just beneath the surface in a lot of these different countries. So again, that's going to limit some of that. When you look at China is something similar where the teapots are down to 2018 run rates. You have and we'll talk about their storage levels, but you're starting to see some of this pivot, and China's been trying to export more and limit the amount that is sitting because they do have a lot of product in storage, and it's all about trying to maintain this, which is where we've seen India exports increasing in September. I think in India it's now to a 4-month high, and then when you look at China, there's going to be a big bounce off that August low when you look at September flows, and as you get into October, we're going to continue to see some of this, but not as much because they're adjusting refinery run rates to try to manage this. But again, China continues to keep runs fairly stable at the export levered refiners and cutting the internal side. So again, trying to maintain and keep some of those margins coming through by selling some of that product into the market in general. So then when you look at crude shipments to Japan and China have risen in September, and then the US is taking less. This is that timing delay that we've been talking about, where you'll start to see this essentially not so much flip because China is going to stay fairly stable, where it's just going to go flat. But the difference is really going to show up. And when we talk about line 3, so line 3 is the line fill starts today. So now we have that starting now. We will see that those barrels that should be running by the middle of the month at about 760,000 barrels a day. Then when you look at what the delivery of these products, this crude into PADD 3, mixed with the fact that imports are going to remain under pressure, and then you have obviously shoulder season run rates, is going to start. That's where we're going to see some of these build, especially in PADD 3 and PADD 2. When we look at what's coming down from Canada. So then when you look at China, because there was a lot made out of the Chinese comments about, buy energy at any cost. But when you look at where it was said and how it was said, it was in front of a shuttered coal mine that was shuttered because of safety concerns. So it was more along the lines of, are we doing this at all cost, or is this more along the lines of all political cost, where i.e. go buy from Australia and the US regardless of politics? And maybe we should get this coal mine back online, fix or address some of the issues, but maybe there's some bigger cause. Because remember that when you think about the party as a unit, there's always that quote unquote greater good. So not to say the life is expendable, because it's not based on how we view it, but it's a little bit different when you look at how some of these movements. But again, we'll get clarifications, and China is now in their golden week, which started today, goes through the end of next week. So that's one of the reasons why some of the misses that we saw on the PMI side on the Chinese economic data is a bit surprising, which we'll talk about in a minute. And then when we look at the amount of crude sitting in Shandong, you can see the only time it was higher was in 2020, but we still remain at these all-time highs, as fuel oil also remains near all-time highs. Where the only time it was higher is in 2014. But when you look at the view of this gas to oil switching, which is really, again, not oil, but diesel, fuel oil, gas oil, essentially that heavy disty side, middle to heavy disty side, that's where there's a lot of product available. And as we've been saying, the one to watch in Singapore was going to be that heavy disty resid, and the same with Fujairah. And you've started to see some of those drawdowns while we've had a big increase in exports from China and India that will help kind of essentially supplement and really backstop where some of that product is gone. It's just those timing delays as to when does it show back up and how much is going to show up in general. And here's when we start to look at refinery run rates, especially in China. When you look at that atmospheric vacuum distillation plant, that is back, which is kind of that key for how these are going to operate. You can see that they're at 68%, which is 2018 levels. You've seen that big drop down. Now, given there's a certain amount of golden week in that, the fact that there's that storage levels, so there's going to be something to manage. But then when you look at the state-owned side, there's been a steady slowdown. But at the same time, the ones that have seen the more support are the ones that are targeting the international markets. But then when you look at the shifting feedstocks, and this is from a presentation that I did on Tuesday, it's important to look at where the changes are, because one of the things that we've been saying since 2019 and really got more aggressive with that view as pricing worked in our favor is really when you start looking at liquids, where liquids, and this is looking at ethane and propane, China petchem production becomes less dependent on oil, with some 16% of ethylene capacity is from ethane and LPG. And it's important to understand where this is looking at what has come on already and what is going to come on. And it's important because when you look at ethane, 87% of the cracker has to be ethane. So your ability to fluctuate shrinks the lower down that molecule curve you go. So if you're running naphtha, you can run heavy naphtha, light naphtha, you can start mixing in gas oil, you can bring in propane, ethane, and you have a bit more flexibility. Where the lower down the curve you go on the molecule size, it becomes more difficult, especially when you look at LPG, which you need 87% ethane, you need about 65% propane, or LPG being propane butane. So there's a certain amount of flexibility, but it's more on the NGL side, which again speaks well for where's the U.S. going, how much is coming from the U.S., where we have those new LPG and ethane ports, export facilities, and ethane, and they're all at records, and they're going to stay at records because a lot of this is going into the Chinese markets, which is why, again, petchem is going to be that biggest driver. And then this is just looking at the amount, when we've shown this chart before, something from BNF, which I think did a great job of bringing it all together. We still have an excess amount of refinery capacity in the market. And a lot of this new refinery capacity coming online are mega facilities with essentially connected to and married with a petrochemical facility to really manage and to bring about the best mix of both feedstock as well as end stock, which when you look at plastics, the environmental movement in terms of EVs and green technology, a lot of plastics, a lot of different types of chemicals go into that. So might as well make the most flexibility. We do expect more closures. A lot of that, again, will be more on the European side, as well as some of the older Southeast Asian nation ones. But it's also important to look at price, because when you look at natural gas, at least in the U.S. at $5.60, you look at how short things are in Europe. It costs a lot of money to run a refinery. You have natural gas and you have hydrogen. How are you making the hydrogen? What is the input cost? So again, there's a lot of cost that is coming through, which is something that I think cutting the OSPs would really help insulate some of those different pieces. But regardless, the pivot to liquids is accelerating as that feedstock is adjusting, as we have new capacity coming online, which is really going to enable and really support where the U.S. is on that NGL production. So then when we look at credit impulses, and we'll touch on this and go deeper next week in the Econ show, it's important to look at where are credit impulses. You can see that for the G3, they've come way down as we've been talking about, and really that's where we continue to see some of this weakness when you're looking at PMIs, especially manufacturing PMIs, with a lot of that weighted towards China and some of the other emerging markets, which are showing some of those slowdowns, which will, again, show up as well in the developed market side. It's just going to be a matter of what are some of those internals, which we'll talk about in a minute. So when we look at some of the data that's come out today, we'll talk about more tomorrow. But when it's not tomorrow, next week. When you look at manufacturing PMI, expectation was 60.5, came in at 60.7. All of the inflationary data is coming in right in line with expectations or slightly above. Nothing too, I think, surprising. When you look at personal income, right in line with expectations of 0.2. Personal spending expected at 0.7, came in at 0.8. But when you look at it revised down last month from 0.3 to negative 0.1, and then real personal spending went from negative 0.1 to negative 0.5. So you get an idea of how some of this is getting a bit sluggish, even though we do have some additional increases in inflation, which again is still shaking that trend, and we'll talk about why we think it's going to continue. University of Michigan is essentially pretty close to in line, not too much adjustment in general. And then when you look at ISM manufacturing, for September, expectations were for 59.5, came in at 61.1. But then when you look at what really caused some of this, ISM prices paid expected at 78.5, came in at 81.2. Again, looking forward to the inflation as we come through September into October. New orders, surprise to the upside. That is a positive when you look at just a continuation of some growth. 63.6 was expected, came in at 66.7, same as last month. And then ISM employment got back to expansion, was expected at 50.2, came in at 50.2, but again, it was at 49, which was slightly contractionary. Now it's just slightly expansionary, which is in line with what we were seeing with some expansion of employment over the last couple of weeks. So then when we look at just how important it is to look at some of the internals, this gives you an idea going back to 2001 where ISM prices have been. And it's one of the things that we were saying is you had some normalcy, but now they're getting worse again. You have everything from wholesale prices going back up, container days waiting to unload is at 9 days now, a record on the West Coast. You keep seeing these bottlenecks continuing to expand. And again, that's leading to day rates going up, dry bulk, container ships, essentially anything you can think of continues to get up, move higher with these different shortfalls. And next week, I'm going to use a graphic that shows about 1,400 chips are in a car. And I think that I actually didn't know it was that much. I'm going to be honest with you. So it's just interesting to see how what that means. How do we close that gap? And this is where we continue to see as supplier delivery times rose from 69.5 to 73.4. So again, you're seeing all of these pressure points just driving higher, which even though the number was good, it's still expansionary. You have to look at some of the internals. There are some positives. Production fell from 60 to 59.4, but still expansionary. New orders unchanged at 66.7, still expansionary, still strong. Employment back to expansion. But then you start looking at supplier delivery times. You look at prices paid. You look at the backlog of orders, which have started to come down, but still elevated, still struggling to keep things operational. New export orders came down from 56.6 to 53.4, but expanding, but still slowing. So you're getting an idea that it's kind of a mixed bag, but even if you were to kind of take and encapsulate some of the things that are negative to it, you still have expansion, you still have growth. It's just where is that going to shake out? And again, it's still looking at what is that future piece, and a lot of it continues to point for inflation. So then just looking at some key metrics that are used by the Fed, the August PC inflation, 4.3% year over year, gives you an idea of where we are in terms of just the underlying 4.3%. You have to go back to, in the 80s. So again, some of these pressure points, you're seeing it, the pace is slowing, but it's still going up. You're still seeing the pressure, and that's something that we expect to continue. Now, one of the interesting things that we looked at and I thought this was a really good chart from BCA Research, a contraction in goods spending. So when you're looking at goods in terms of how far we are off of baseline, and not to say that we're going to come back to baseline, because there's a certain amount of, well, what is the volume versus value, as we keep talking about. Value is the one that continues to be the struggle, and that's where we're going to see volume contract. But as volume's contracting, you still have prices that have gone up, which is keeping things elevated, but you will see some fall down. It just won't be as much. But if you see a true move back to essentially baseline, that's where you could see a fairly large decline in GDP growth and consumer consumption, which obviously is about 70% of GDP. So if real good spending were to come back to pre-COVID trend, it would lead to a roughly 10% year-over-year contraction, which is in line with drop at outset of pandemic, which is more severe than usual contractions in recessions. Again, we're short on inventory, so you'll have corporations buying inventory to refill. So even though you have demand slowing, you'll have some of that kind of built up support. So that would offset. So even if this played out, you would still have some positive contribution given how low inventories are, where the supply chain sits. So again, it's hard to look at something in a vacuum, but this just gives you an idea on what some of the pressure points could be as we keep talking about that inherent slowdown, because you've pulled forward so much demand with so much fiscal and monetary stimulus that you're going to have some of that slowdown on the back end. The question is just going to be how much, and that's where we talk about some of that insulation that we'll get from just the inherent supply chain refilling itself, if you will. And then when you look at construction spending, was flatlined in August, was at 0% versus the estimate of 0.3%. So again, just kind of sitting sideways, not too much to say one way or the other. Then when you look at personal income, softer in August of 0.2% versus 0.2% estimate. And then in 1.1% in the prior month spending, again, revising down a bit. So we're not seeing that huge increase on the income side as we've been talking about, because income is going up, but look at inflation. Inflation is outpacing that, which again creates some of that struggle that we've been talking about. Then when you look at the shift in employment, remote work, the question, and I had this conversation with Ryan Ray, does it make sense to hire a full-time employee and pay W-2 wages, pay W-2 taxes, and then benefits that come along with it, or do I 1099 someone? If you're not going to be in the office anyway, well, can I use a freelancer? Can I use a consultant? And then I can 1099, so I don't have to pay taxes. I don't have to worry about benefits. I'm going to push that essentially exposure or risk off to, or I should say cost really, off to the freelancer. And that's where we're starting to see some of this movement, which is where you're getting that more and more likely, which again is shifting some of how many jobs are available, what kind of jobs are available, how long do you need freelance? Is it hourly? Is it going to be over the course of a week, a month, a year? Some of these things, again, create some of that flexibility, if you will, on how many jobs are really available, how many people are really looking for employment, or how many are doing freelance and getting an unemployment, and then once their unemployment goes away, they really haven't gotten a job because they're making a decent salary, net when you think of on the freelance side. So again, some interesting caveats that we'll dig into further next week. But then looking at China, so a lot of people have been hitting me up on Twitter talking about the PMI data. So remember we were saying that we expected a bump in non-manufacturing PMI. So when we looked at what happened in August, you had a lot of lockdowns, you had a lot of issues in terms of where the COVID outbreaks were. And the COVID outbreaks on the buying side were in coastal cities. They were big. They were in populated areas that you had slowdowns, where when you look in September, they were smaller and they were more rural. They were isolated a bit more. So the impacts were going to be really not as hit as much. And when you looked at August into September, you actually had a decent bump coming from August into September. Now, things have slowed drastically to close out September, so October is going to get much worse. But again, you kind of have this insulated bump. And then when you look at the manufacturing side, I was expecting to kind of hold right around this level, as we said essentially last month, that we were going to be able to keep some of this just above expansion. Instead, we came just below contraction. And the reason why is when you look at just, obviously you had some of the hiccups with COVID, but when you look at some of the issues on the power side, that started to increase towards the end of the month. But remember, this is Golden Week. So typically you have manufacturing increase ahead of Golden Week so that there's shipments available, there's product available. They try to get it through the factory, on a boat, on the water, I should say, on a ship, for those that have been correcting me, on a ship into the water to try to, again, kind of insulate themselves. So the fact that we still had contraction in front of Golden Week, I think is very concerning, and it bodes poorly really for what October is going to look like. So the non-manufacturing pulled the composite to 51.7, but then when you look at the Caxton side, it was expected at 49.5, came in at 50. Again, same thing. We expected it to be just about expansionary, right on that line, but it doesn't set up well for October. And again, there's a lot of pressure that continues to mount, which is why we continue to see some of these pressure points. Then when you look at Chinese demand for thermal power, you had this big explosion in power demand when you're looking at 2021. And especially through August. So you had a heat wave, you had a push for that manufacturing side, you had a lot of these facilities trying to run as hot as possible, but now you're sitting there and you're seeing a lot of these cuts because in the beginning of the year, they set caps for the amount of carbon they could produce, for the amount of electricity they could consume, and we've kind of hit this point where it was an artificial cap set in January. They could lift it, it's just how much does it cost? How much coal is available? And when you look at the fight they've had with Australia, India is at their stockpiles are at multi-year lows. They've mismanaged this from not only the consumption side, but also the politics side, the political side, the availability side. Now they don't have any choice but to cut, and they're going to use those caps as a means to do so. But remember, there was that big push in September that is now abated. So, and when you look at just where demand is, where flows are, you don't need to get back to these levels. So I think you can see some of this cut that we've normally seen on a historical level. When you look back through October, November, that's typically a very low period in terms of seasonality for power consumption. So that will also give them a time to adjust. And they're also sitting on a record amount of fuel oil. They can consume that internally. They can use that for themselves. So that's going to be something to watch. And again, these are things that we're going to flesh out more next week on our Econ show, especially in segment 5. So that's all we have for you today. We hope you have a great weekend. For me, just soccer with the family, some fall festivals, and a much needed haircut. So that will be on the agenda for me. Hopefully everyone else is starting to enjoy some of the fall weather with apple picking, whatever you do to celebrate the change of seasons. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.